Welcome back, everyone. 31.29%. That's the current compounded annual growth rate for the four-factor portfolio following March of 2024. During the past 17 months, this portfolio has grown at this phenomenal rate of return. Granted, the stock market as a whole has performed very well during this time as well. The S&P 500 has a CAGR of 26.12%, and SCHD has a CAGR of 10.48%. So thus far, the portfolio I have dedicated to following this strategy has delivered results that are above my expectations. The goal for this portfolio is to have a 12% CAGR over a long period of time. I'm talking about decades here. In last week's episode, I spoke about why I believe this strategy works and why it has the potential to continue working. But like any strategy, there are no guarantees it will deliver the type of returns I expect it to. I'm not advocating for anyone to follow this strategy. I'm sharing the process simply for informational purposes. What you do with this information is completely up to you. You can take bits and pieces that resonate with you and use them to improve your strategy. I'm trying to be as transparent here as possible. The portfolio will see bad months, and the long-term CAGR will decline in the long run. I designed this strategy to be a simple, rules-based approach to building my own custom version of SCHD. I like the concept of using a rules-based approach because it removes any emotion and bias from the process of selecting which stocks to buy and when to buy them. The stock selection process attempts to identify high-quality companies that are trading for reasonable valuations. It's a purely quantitative model, and as such, there is a possibility it will include some not-so-great stocks in the mix. Since its inception in November of 2022, I've made several improvements based on patterns I have observed. These decisions were linked to improving the overall return and also simplifying the process. The way the strategy works now is once per year, I use the four-factor approach to identify the 20 most opportune stocks. I invest equally in these positions and hold them for a full year. Then I simply repeat the process. The actual portfolio tracking this strategy is made up of 25 stocks. But as you'll find out a little bit later, the 20 stock model is actually a better option to go with. And when it's the next time to rebalance the portfolio, I will only be investing in the 20 chosen stocks. Alright, let's take a look at the portfolio and the individual holdings. March was another decent month. The portfolio returned 3.66%, which was 0.45% better than the S&P 500, and 0.99% worse than SCHD. We've actually seen 5 consecutive months of positive returns for SCHD now. I'm sure all long-term shareholders are happy to see the fund rebounding nicely after struggling to keep up with the market last year. The portfolio was rebalanced on November 1st, 2023, so we are 5 months into fiscal year number 2. The portfolio has seen a positive return for 4 out of these 5 months. January was a bit of a hiccup, but it didn't have a major impact on the overall return. During these 5 months, the portfolio has beaten the S&P 500 during 4 months, and SCHD during 3 months. The fiscal year 2 return for the portfolio is 32.6%, which is 6.47% better than the S&P 500, and 12% better than SCHD. The portfolio definitely sees more volatility relative to the S&P and SCHD. This volatility can be a good thing, because when a strategy wins, it can win big, and when it loses, those losses aren't terrible. I imagine if we see more negative monthly returns on the horizon, some of this early alpha will be lost. The average return during March for all 25 stocks held in this portfolio was 3.53%, so the actual portfolio performed a little better. It's very difficult to keep this portfolio at equilibrium, with individual stock prices constantly moving up and down. 2 stocks saw excellent returns in March. They were Williams-Sonoma that was up 34.82%, and EOG Resources that was up 11.69%. Watsco was very close to seeing a double-digit gain as well. It was up 9.6%. Out of the remaining 22 stocks, 17 saw positive returns, and 5 finished the month in the red. The worst return came from Infosys, that dropped by 10.17%. Following March, all 25 stocks now have a positive return in fiscal year number 2. In the prior month, we had 1 stock still sitting in the red. That stock was EOG Resources. But after a strong showing in March, it has moved into positive territory over the last 5 months. Albeit, it still has the weakest individual return in this portfolio. The best performing stock in fiscal year 2 is Williams-Sonoma, that is up more than 112%, which is just nuts. In a distant second place, we have Lam Research and ASML Holdings that are up more than 60%. And Broadcom, Masco, and Monolithic Power Systems are each up more than 50%. In total, 20 stocks have double-digit returns since November 1st. and the remaining 5 stocks have positive returns in the single-digit range. One of the things I track is how each stock is performing relative to where it ranked in the original stock selection process. During March, the top 5 highest ranked stocks performed the best, on average seeing a return of 10.21%. The worst performing group of stocks were stocks ranked 6 through 10, that on average fell by 2.48%. Since November 1st, stocks ranked 1 through 20 are all performing well, with each 5-stock subset of this group seeing a return in excess of 30%. The best segment of stocks are the stocks ranked 16 through 20, with a return of 37.39%. The lowest ranked 5 stocks are currently underperforming the portfolio as a whole. Since November 1st, they have an average return of 22.62%. This means that had I opted to construct this portfolio with just the top 20 stocks, I would currently have a better return. This is one of the changes that will be implemented for fiscal year number 3. The perfect equal weight allocation is showing 2.41% of alpha for the 20 stock portfolio over the 25 stock portfolio. Another thing that I am testing is whether the monthly rebalancing to bring the portfolio allocation back to equal weight is favorable. In March, the non-rebalanced portfolio would have returned 0.19% more, and since November 1st, the non-rebalanced portfolio would have generated a return of 0.45%, higher than the rebalanced version of the portfolio. This is another change that will likely be implemented in fiscal year number 3. This pilot portfolio is held in a traditional IRA, so it is not impacted by capital gains taxes, hence the flexibility to rebalance it on a monthly basis. It's quite a small portfolio, with the current market value just shy of $2,600. For full disclosure, I have invested considerably more capital into this strategy over the past 16 months. To not overly complicate things, I am sticking to just documenting and sharing the results of this one original portfolio. Since this is a dividend growth strategy, it's prudent we discuss the dividend history as well. In March, the portfolio paid out $5.32 in dividend income. This was 48.19% higher than March 2022 dividend income. The 5-month dividend income total for fiscal year 2 currently stands at $25.33, compared to the 5-month dividend total for fiscal year 1 of $15.68. Fiscal year 2 is about 61.5% higher. Not a bad rate of change thus far. The portfolio has a current dividend yield of 2.15%, and it's projected to generate $60.06 in forward annual dividend income. The original forward annual dividend income when this portfolio was launched on November 1st, 2022 was $46.79. This gives us a dividend growth rate of 28.36%, or 19.27% if we annualize it. A very high dividend growth rate in my opinion, but bear in mind that this rate of growth isn't organic, as the composition of the portfolio changed last November as a result of the annual reconstitution process. Since the portfolio will go through this reconstitution process each year, in theory, it's possible that it may not see positive dividend growth every year, especially if the newly selected constituent stocks have a lower yield compared to the prior year's selections. I launched this portfolio in November, and it's always going to be on this fiscal year cycle from November 1st through October 31st. But I was curious what type of results this strategy would produce had I started during a different month. Since June of 2023, I've been pulling and tracking the 4-factor strategy each month. The initial results are promising. The 11 4-factor lists between June of last year and April of this year are all performing very well relative to both the S&P 500 and SCHD. Granted, the April list has only been live for a few days, so the jury's still out on how it will perform during a full year. Thus far, only the January 2024 top 20 list is trailing the S&P 500. The margin is 3.31%. And thus far, all 4-factor lists are outperforming SCHD. I intend to track each list for a full 12 months, and then compile the returns for further analysis. Another thing that I am testing here is whether going through a monthly reconstitution process would be favorable opposed to holding the original selections for the full 12 months. Thus far, the monthly reconstitution would be more favorable in 8 out of the 10 test portfolios. I'm not counting the April 2024 selections here, since they don't have enough data to answer this question. Obviously, swapping out stocks on a monthly basis would only make sense in tax-free or tax-deferred accounts, and would not be recommended in a taxable brokerage account. Something I plan on analyzing in the future is the capital gains tax impact the strategy may incur in the long run, and how this tax drag impacts the long-term performance. I need to collect a little bit more data to start analyzing this aspect. This spreadsheet is shared with my Patreon community, so they can follow along with this strategy and see the chosen stocks that are published at the end of each month. I hope you enjoy the content. If you did, please do me a favor, give this video a like and subscribe to the channel. Thank you for watching and see you next time.